Welcome to Looking at the Markets with David Moadel. Just a quick video today because today is September 21st, 2016. Today was a big Fed decision day. Janet Yellen came out at 2 o'clock p.m. and announced that she right now is not planning on raising interest rates. So it was a big day. And as you can imagine, and now that it's passed, I'm sure you know by now that the market went, the stock market went up today a lot because the Fed announced that it's not going to raise interest rates, and so the market was very happy with that. But before 2 o'clock p.m. today, a lot of people bought puts or calls or both. Maybe they bought a straddle or a strangle. They were hoping for a big move in the market. If they bought a call option, they wanted the market to go up a lot. They were hoping, and they were right. They were hoping that Janet Yellen would not announce a Fed or an interest rate hike, and she did not. People who bought puts were hoping that she would announce an interest rate hike, and they were hoping that the market would go down a lot today, which did not happen. So the question is today, is it a good idea to purchase options, puts, calls, straddles, strangles, whatever, right before a big decision or a big event, such as an earnings report, or such as today's example, such as a big Fed announcement or decision? Well, let's examine this because today is a perfect example. All right, I took a screen capture right before the big Fed announcement today, before Janet Yellen's big announcement as to whether she was going to raise or hike interest rates today. All right, so that was at 2 o'clock, and I took the screen capture at 1:52 p.m., 8 minutes before. And as you can see, the price of SPY, and that's the spiders, which tracks the S&P 500 index, the price at that moment was $213.82. All right, so this is an at-the-money call, a 214 call, expiring today at 4 o'clock p.m. And at 1:52 p.m., right before the Fed announcement, you can see how expensive the call option is. It's usually not this much, especially if it's going to expire in a couple of hours at 4 o'clock p.m. today. It's about, let's say, $88 per contract. All right, 88 cents per share, or $88 per contract. That's a lot. And why does it cost so much? Because the IV, the implied volatility, is so high. There's a lot of anxiety, uncertainty. Everybody was talking about, is Janet Yellen going to announce a rate hike or not? All right, so the implied volatility component of the call option premium is very high. And so really the call option is too expensive. But in any case, what happened to the price of SPY afterward? Well, it went up because Janet Yellen, in fact, did not announce an interest rate hike today, and the investors were very happy about that. They were very pleased. And so since SPY went up, you'd think that the call option price would go up with it, right? Nope. We can see that the price of SPY went up. It went from $213.82 at 1:52 p.m. About half an hour later, at 2:28 p.m., SPY went up to $213.91. But look at the price of the call option. It went down from 88 cents a share. Here it is, 52 cents a share. $88 a contract to $52 a contract. Why? Because some time had passed. Yes, that's true. But I believe mainly it's because the implied volatility component of the option price, the option premium, had been removed because now the uncertainty was gone. The anxiety and wondering and hoping and thinking about what's going to happen, it's gone now. And so look at what happened. Even though you might have been right on the direction, if you purchased a call option about half an hour later after the Fed decision announcement, your call option suffered quite substantially, went down a lot. And as you can imagine, the put options did even worse. Here's a screen capture at 1:52 p.m. right before the Fed announcement of an at-the-money put option. Really expensive here. Put options tend to be expensive because the implied volatility, again, is so high right now. And people are buying protection for their investments. And so here it is, $1.07 a share. That's way too much, I think, for an option that's going to expire in a couple of hours. That's $107 per contract. And we can all pretty much guess what happened about half an hour later at 2:28 p.m. from $107 per contract to $59 a contract. Yeah. Pretty devastating. So whether you bought a call or a put, at this moment you lost money. Even if you got the direction right, you lost money. And if you bought a straddle, which is an at-the-money call and an at-the-money put, you definitely would have lost money. And if you had bought a strangle, you wouldn't have done too well. A strangle is an out-of-the-money call and an out-of-the-money put. You would have lost either way. So what's the takeaway? Well, instead of buying options right before an earnings report or a Fed decision day or some other big event, you might want to consider selling options instead. Now, you have to be careful with it. If you're going to sell options, you really need to know what you're doing. Don't just start doing it if you don't know what you're doing. But I believe that selling options before a big event is oftentimes more profitable than buying options at a very inflated price right before a big event. And so if you'd like to talk to me about this, if you'd like some help with this, or you want help just putting together a trading plan involving stocks, options, whatever you like to invest in or trade, you can send me an email anytime. My email address is davidmoadel@gmail.com. And if you like this video, please give it a thumbs up on YouTube, leave a comment, I like to read your comments, and subscribe to my channel so you can get the latest updates on my educational financial content. Thank you so much for listening and watching, and I hope to talk to you soon.